It's incredible how Bitcoin has performed this quarter.
Absolutely. Institutional adoption is really driving the growth.
It is.
Let me tell you what happened on the 6th of October, 2025. Bitcoin hit $126,198. The financial media declared the dawn of a new era, the institutional era, the sovereign era, the era in which Bitcoin had finally permanently arrived. That was 6 months ago. Today, Bitcoin trades at $74,000, down 46% from that historic high. 6 months of selling, 6 months of headlines, 6 months of the same analysts who told you to buy at 120,000, now quietly updating their models and calling it a healthy correction. And somewhere on a trading desk in Lower Manhattan, a risk manager just printed a chart showing that Bitcoin has lost nearly half its value since October and stapled it to a memo that says, and I quote, "See, we told you." Here's the problem with that memo. On April 6th, 2026, 9 days ago, United States spot Bitcoin ETFs recorded $471 million in net inflows in a single day, the highest single-day total since February. On April 14th, after 5 consecutive days of outflows totaling $1.72 billion, BlackRock's IBIT alone posted $269 million in new capital in a single session. And this morning, with Bitcoin still sitting 46% below its high, institutions added another $358 million across all spot ETFs combined. So someone is very aggressively buying what the mainstream says you should be selling. And the only question that actually matters right now, is whether they know something you don't. The answer to that question is what this video is about. Because there are two completely legitimate, data-driven, on-chain verified stories being told about this market simultaneously. One story says Bitcoin is entering the deepest phase of its bear market, and the real floor has not been printed yet. The other story says institutional accumulation at this scale, during a 46% drawdown, has never happened at any previous cycle bottom. And that changes everything about how this bear market ends. Both stories have evidence. Both stories have respected analysts behind them. And by the end of this video, you are going to have the framework to decide which one you believe. Stay with me. 5 things are going to land before this video ends. Number 1, you are going to see exactly what the on-chain data says about where we are in this bear market cycle. Not opinions, data. The same data that called the 2022 bottom 6 months before it happened. Number 2, you are going to understand why the 4-year halving cycle, the model that every crypto trader has used as a roadmap since 2012, may be fundamentally broken by the arrival of institutional capital, and why that changes the math on when this bear market ends. Number 3, you are going to see the one number that has never existed in any previous Bitcoin cycle, and that makes this bear market structurally different from everyone that came before it. Number 4, you are going to hear the full bear case. No sugarcoating. The analysts calling for $55,000 get a full hearing in this video, because this channel does not do propaganda. Number 5, you are going to walk away with a framework for reading this market that does not depend on price predictions. It depends on understanding what institutional accumulation during a bear market actually means, and what has always happened next. This is engineered markets, and the only thing we engineer here is clarity. Let's start with what the data actually says. The most honest place to start any market analysis is the realized price. The realized price is not the current price of Bitcoin. It is the average price at which every Bitcoin currently in circulation was last moved on-chain. It is, in the simplest terms, the average cost basis of every holder in the market. And it is the single most reliable indicator of where genuine capitulation, the kind of capitulation that marks a definitive cycle bottom, has historically occurred. Right now, Bitcoin's realized price sits at approximately $59,000 to $60,000. Bitcoin itself trades at $74,000. That means the current price is 21% above the average holder's cost basis. Most holders are still in profit, and that is a problem if you are looking for a bottom. Here is why that matters. In every previous Bitcoin bear market, 2015, 2018, 2022, the definitive bottom was not reached until Bitcoin's spot price fell below, or very close to, its realized price. In the 2022 cycle, Bitcoin fell from $69,000 to $15,500, a 77% collapse, before the realized price was finally breached and long-term buyers stepped in at scale. The pattern is consistent across cycles. Price falls below average cost basis. Widespread losses force weak hands out. Long-term holders accumulate the supply at a discount. The floor is formed. The cycle restarts. As of April 1st, 2026, on-chain data from CryptoQuant confirmed that Bitcoin's spot price remains well above the realized price, meaning the conditions historically required for a definitive bottom have not yet been met. The market, as one analyst put it, is nearing a bottoming phase, but several months of consolidation are likely still ahead. Then there's the MVRV Z-score. The MVRV Z-score measures the deviation between Bitcoin's market value and its realized value, standardized against historical volatility. When the Z-score enters the green zone, when market value falls significantly below realized value, it has historically marked generational buying opportunities. It called the bottoms of 2015, 2018, and 2022 with remarkable precision. According to CryptoQuant data, the MVRV adaptive Z-score recently read negative 2.66. One analyst from CryptoQuant described this reading as confirmation that Bitcoin remains persistently in the capitulation zone. But here's the critical nuance. At every previous bear market iron bottom, the MVRV Z-score fell below the zero axis entirely, entering negative territory that signals the market has moved from capitulation into true undervaluation. That crossing has not yet occurred in this cycle, which means, by this indicator's historical logic, the deepest part of this bear market may still be ahead. The long-term holder data tells a similar story. Long-term holders, defined as addresses holding Bitcoin for 6 months or more, currently control approximately 80% of Bitcoin's circulating supply. In every previous cycle, bear market bottoms have coincided with long-term holders controlling at least 85% of supply. The logic is simple. When long-term holders control the majority of supply, the remaining coins are held by committed accumulators rather than speculative traders. Price stability follows because the people who are left are not going to sell. CoinDesk analysis from April 2nd of this year noted that the current 80% reading means the market is approaching, but has not yet reached the historical threshold. If this trend continues, if long-term holders continue absorbing supply from discouraged sellers, the market may be nearing a bottoming phase, but the data suggests several more months of range-bound, exhausting, time-intensive pain are likely before a sustained recovery begins. And then there is the net realized loss figure that almost nobody is talking about. On February 7th, 2026, Bitcoin's net realized loss hit $13.6 billion. That is the largest single-day realized loss figure recorded since the 2022 bear market. The Onchain analytics firm Glassnode noted that the 2022 loss peak occurred 5 months before the actual bear market bottom was printed. Apply that same timeline to the February 7th reading, and you get a projected bottom around July 2026. CryptoQuant's base case is more conservative, an iron bottom in the $55,000 to $60,000 range, forming around December 2026. Their analysis is built on multiple indicators, including the MVRV Z-score, the bull score index, and realized loss dynamics. The composite picture is not one of imminent recovery. It is one of a market that is grinding toward its bottom with structural patience, not speed. Hold on. Before we go further, if you made it to this point in the video, you are not the average viewer. Most people click away in the first 60 seconds. You stayed through the hard part, through the on-chain data, through the bear case. That tells me you are serious about understanding this market, not just looking for someone to confirm what you already believe. I want to know where you're watching from right now. Drop your city in the comments. Tell me what time it is there and what the weather looks like outside your window. Because this channel is built for the person who wakes up early, stays up late, and does the reading that everyone else skips. That is you, and I want to know where in the world you are. And if this analysis is landing, if you are seeing the data the way we are seeing it, hit the like button and subscribe. It costs you nothing. It tells the algorithm that people who think seriously about markets deserve serious content, and it helps us keep building this for you. Let's talk about the framework that has governed Bitcoin market analysis for over a decade. Since 2012, Bitcoin has followed a cycle that aligns with its halving events. Every 4 years, the reward for mining a new Bitcoin block is cut in half. This reduction in new supply, combined with steady or growing demand, has historically triggered the same sequence: accumulation, parabolic rally, speculative peak, collapse, recovery. The pattern repeated in 2012, 2016, and 2020. And every time it repeated, the people who understood the cycle outperformed everyone who didn't. The fourth halving occurred on April 20th, 2024, reducing the block reward from 6.25 Bitcoin to 3.125 Bitcoin. Based on the historical pattern, bull run peaks approximately 18 months post-halving, the model predicted a cycle top somewhere between September and December of 2025. Bitcoin peaked on October 6th, 2025. The model was almost exactly right. Now here is where it gets complicated. In previous cycles, the peak to trough decline has been brutal. 2018, 84%. 2022, 77%. Those are not corrections. Those are destructions. the kind of drawdowns that liquidate leveraged positions, bankrupt exchanges, and force retail participants to exit the asset class entirely. If the current cycle follows the same percentage decline from the October 2025 high of $126,000, the math produces the following targets. A 77% decline lands at $29,000. An 84% decline lands at $20,000. But the current drawdown, as of today, is 46%. Painful, but mild by historical comparison. And the question the entire analyst community is wrestling with is whether the relative shallowness of this decline means the bottom is still far away, or whether the structural changes in Bitcoin's market, specifically institutional capital and ETF infrastructure, have permanently reduced the severity of bear markets. Grayscale made the case for structural change explicitly. In their November 2025 market commentary, Grayscale said they do not expect Bitcoin to enter a prolonged 2 to 3 year drawdown, similar to past cyclical declines. Their reasoning was direct. The current market structure differs from prior cycles due to the influence of exchange-traded products and corporate digital asset treasuries. Put simply, when BlackRock and Strategy and Morgan Stanley and 154 other public companies are sitting on hundreds of billions of dollars worth of Bitcoin they are not selling, the supply dynamics that drove 80% crashes simply no longer exist in the same form. The halving itself is also delivering diminishing supply shocks. In the 2024 halving, Bitcoin's annual inflation rate fell from 1.7% to 0.85%. With 94% of all Bitcoin already mined, each subsequent halving reduces a smaller and smaller marginal share of total supply. The supply-side catalyst that powered the 2020 and 2021 bull run is, by mathematical necessity, weakening with each cycle. Macro forces and institutional flows are taking the wheel, but there is a counter-argument that deserves full respect. The analysts calling for a deeper bottom point to timing. Using the historical average of 370 days from cycle peak to cycle trough, and applying it to the October 6, 2025 ATH, you arrive at a projected bottom around October 2026. 6 more months of potential downside from today. The Onchain data, the MVRV Z-score still above the green zone, long-term holders at 80% rather than 85%, realized price still 21% below spot, supports the view that the market is cycling toward a bottom, but has not yet arrived. Professor Zhang Shuiqin's framework for reading monetary and market cycles offers a useful lens here. Zhang argues that in any system undergoing structural transformation, the old rules apply until they demonstrably don't. The 4-year cycle has held through 3 halvings, 2 major exchange collapses, 1 global pandemic, and multiple regulatory crises. The burden of proof for declaring it broken is high, and the honest position, and the only defensible analytical position, is that we are watching a modified version of the cycle play out in real time, with institutional participation acting as a stabilizer that prevents the deepest historical drawdowns while still following the general directional logic of halving cycles. Which brings us to the number that makes this bear market unlike any that came before it. Here's the number, 100%. Bitwise Asset Management, one of the largest cryptocurrency investment firms in the United States, projects that United States-listed Bitcoin ETFs will purchase more than 100% of all new Bitcoin issuance in 2026. That means the institutional demand flowing through regulated ETF vehicles alone is projected to exceed the entire new supply being created by miners. Every single new Bitcoin that enters existence is being absorbed, and then some, before it can reach the open market. In the entire 17-year history of Bitcoin trading, this has never happened. Not in 2017, not in 2020, not in any previous cycle. The infrastructure did not exist. The regulatory clarity did not exist. The institutional conviction did not exist. It exists now. Let's put some context around that projection. The first quarter of 2026 alone added $18.7 billion in net ETF inflows globally. If that quarterly pace holds through the rest of the year, 2026 will surpass both 2024, which recorded $48.7 billion, and 2025, which recorded $47.2 billion, as the largest year for Bitcoin ETF inflows in history. JP Morgan projects that total crypto inflows in 2026 will surpass the 2025 record of $130 billion. Meanwhile, the post-halving mining reward sits at 3.125 Bitcoin per block. At current mining rates, approximately 450 new Bitcoins per day enter circulation. At $74,000 per Bitcoin, that is approximately $33 million worth of new supply created daily. The Q1 2026 ETF inflow pace implies institutional absorption of roughly $200 million per day. The ratio of institutional demand to new supply is approximately 6 to 1, not 100%. 600%. This creates a supply dynamic that has no historical reference point in Bitcoin's prior cycles. In 2018, the crash from $20,000 to $3,000 was driven partly by miner selling. Miners who had accumulated Bitcoin at profitable prices and needed to liquidate to cover operating costs as the price fell. In 2022, the cascade of failures, Luna, Three Arrows Capital FTX, created forced selling at scale that overwhelmed any institutional support. Neither of those supply pressure dynamics exists in the same form today. Miners are selling into an ETF bid that is structurally larger than their collective output. Corporate treasuries are not selling. The United States government is not selling its strategic Bitcoin reserve, and ETF shareholders, the new generation of long-term institutional holders, have already demonstrated through 48 out of 62 trading days of accumulation during a 25% price decline that they buy the dips rather than sell them. In the week of April 14th alone, whale addresses, defined as wallets holding between 10 and 10,000 Bitcoin, absorbed more than 61,000 Bitcoin from the open market. That is approximately $4.5 billion in organic accumulation in a single week at current prices. Not ETF flows, not miner sales, direct wallet accumulation by the largest and most informed market participants on Earth. Now let's add the next halving to this equation. The fifth Bitcoin halving is projected for April 2028. When it occurs, the block reward will drop from 3.125 Bitcoin to 1.5625 Bitcoin. New daily supply will fall from approximately 450 coins to approximately 225 coins. If institutional ETF demand holds anywhere near its current pace, and there is no structural reason to believe it will decline given the expansion of distribution through Morgan Stanley, Fidelity, BlackRock, and every major wealth management platform in the country, the supply-demand imbalance does not get smaller after the 2028 halving. It doubles. Analysts at Cryptalia, modeling the sovereign adoption narrative alongside ETF demand and the 2028 halving, project that the peak of the next bull market cycle could occur in the second half of 2029. The framework is not complicated. Bear market accumulation through 2026, recovery and reaccumulation through 2027, post-halving supply shock amplifies institutional bid in 2028 and 2029. The cycle does not end. It slows down, compresses in volatility terms, and then runs again. But this time, with sovereign wealth funds and pension allocations in the passenger seat alongside the retail buyers. Standard Chartered's global head of digital asset research, Jeff Kendrick, holds a price target of $150,000 for Bitcoin in 2026. Citigroup projects $143,000 by year end. BlackRock's own IBIT analysis implies a price range of $150,000 to $250,000 based on continued institutional inflow projections. These are not anonymous Twitter accounts. These are the research desks of the largest financial institutions in the world, staffed by the most credentialed analysts money can hire. And they are all looking at the same supply-demand arithmetic and arriving at the same conclusion. The current bear market is not a preview of Bitcoin's failure. It is the entry point for the next phase of its adoption. This channel does not do propaganda. The bull case for this market is real, and it is supported by data. But the bear case is also real, also supported by data, and it deserves a full and honest hearing before you make any decisions about what you believe. So here it is. No spin, no qualifications designed to undermine it. The complete bear argument. The first and most fundamental bear case is the simplest one. On-chain data does not support a bottom at current prices. Full stop. The realized price argument is not a minor technical note. It is a structural observation. In 2015, Bitcoin fell below realized price before bottoming. In 2018, it fell below realized price before bottoming. In 2022, it fell below realized price before bottoming. The current realized price sits at approximately $59,000 to $60,000. Bitcoin today trades at $74,000. For the pattern to hold, Bitcoin needs to fall another 18 to 20% from current levels just to test the realized price. An actual breach, which is what historical bottoms require, implies a target below $60,000. CryptoQuant's iron bottom projection of $55,000 to $60,000 by December 2026 is not speculation. It is a direct application of the same indicator that called the previous three cycle bottoms. The MVRV Z-score has entered negative territory, below the zero axis, at every single bear market bottom in Bitcoin's history. It has not done so yet in this cycle. If the Z-score follows its historical pattern, the reading of negative 2.66, recorded in early 2026, is not a bottom signal. It is a mid-cycle capitulation reading. The actual bottom, by this metric, requires prices low enough to push the Z-score into true negative territory, a condition that has historically corresponded to realized price breaches in the $50,000 to $60,000 range. The long-term holder data adds another layer of caution. Long-term holders currently control approximately 80% of circulating supply. The historical threshold for a confirmed bear market floor is 85%. That 5 percentage point gap sounds small, but in the context of Bitcoin's market structure, it represents an enormous amount of supply that has not yet been converted from uncertain hands to convicted long-term holders. The coins that need to move from the 80 to 85% level to complete the transition are currently held by people who bought between $60,000 and $126,000 and are sitting on losses or minimal gains. Some of those holders will sell before the bottom. That selling pressure is the final clearing that CryptoQuant analysts say is still ahead. The bear score from CryptoQuant's bull score index has remained in bearish territory since late 2024. Most of its underlying components, network activity, investor profitability, liquidity conditions, buying pressure, have been weak for over 18 months. The composite picture is of structural cooling, not cyclical correction. The index is designed to identify extended downtrends rather than temporary pullbacks, and it is currently saying extended downtrend. There's also a macro argument that the bulls have not fully answered. The Federal Reserve's quantitative tightening ended in December 2025. Rate cuts are expected through 2026. Global M2 money supply is expected to expand. These are bullish macro conditions for risk assets, but the timing matters enormously. Rate cuts work with a lag. Liquidity injections do not immediately translate into asset price appreciation. And Bitcoin's correlation with global liquidity, which strengthened significantly after the launch of spot ETFs, means that the asset will likely wait for macro confirmation before beginning a sustained recovery, regardless of what ETF flows are doing in the short term. And finally, the bear case on institutional flows themselves. The fact that ETFs are recording inflows during a bear market does not guarantee a bottom. In fact, one of the most dangerous patterns in institutional market behavior is the slow accumulation that continues right up until a final violent clearing event. ETF inflows absorbing supply does not prevent a capitulation spike. It may simply mean the capitulation, when it comes, is shorter and sharper rather than long and grinding. The October 2025 liquidation event, which wiped out $19 billion in leveraged positions in under 24 hours, was the largest in crypto history. Another event of that scale, touching a lower price level, would be consistent with both the bear case fundamentals and the institutional accumulation pattern simultaneously. The bear case, in summary, is not crazy. It is historically grounded, on-chain supported, and backed by some of the most respected analytical platforms in crypto markets. If you are positioning based on this analysis, the bear case says the bottom is not yet in, the iron floor is likely between $55,000 and $60,000, and the timeline to that floor runs through the second half of 2026. That is a serious argument. It deserves serious weight in any portfolio decision you make. Now let's look at the framework that reconciles both cases. Professor Zhang Shuichen has spent years building a framework for understanding how systems transition. His core insight is not about Bitcoin. It is about the difference between a market that is dying and a market that is maturing. A dying market looks like a bear market. A maturing market also looks like a bear market. The difference is not visible in price. It is visible in behavior, specifically in who is accumulating, at what scale, and with what time horizon. Applied to Bitcoin in April 2026, Zhang's framework asks a single question. Is the current bear market characterized by abandonment or by consolidation? Abandonment looks like what happened to countless altcoins in 2022. Exchange collapses, protocol failures, retail participants exiting and not returning, institutional interest evaporating. Consolidation looks like 48 out of 62 days of ETF inflows during a 46% drawdown. It looks like 61,000 Bitcoin absorbed by whale wallets in a single week. It looks like the United States government holding a strategic Bitcoin reserve and not selling a single coin as price falls from $126,000 to $74,000. This framework produces a specific prediction. If Zhang's consolidation thesis is correct, and the behavioral data strongly supports it, then the current bear market is not a cyclical reset that returns Bitcoin to $20,000 or $30,000. It is a structural compression that is concentrating ownership in the hands of the most patient, best capitalized, longest horizon holders in the asset's history. When that compression ends, when the final selling pressure from underwater retail holders is absorbed and long-term holder supply reaches its historical threshold, the market does not just recover, it reprices permanently to a level that reflects the new ownership structure. The halving of 2028 amplifies this dynamic. Post-halving supply drops to approximately 225 new Bitcoin per day. At the current ETF demand pace, that means ETFs are absorbing the equivalent of more than 3 days of new supply for every single day of new issuance. The supply shock that powered 2021's $69,000 ATH operated in a market without spot ETFs, without a strategic Bitcoin reserve, and without 154 public companies holding Bitcoin on their balance sheets. The 2028 supply shock operates in a completely different market structure. The same match, larger amounts of gasoline. The reconciliation between the bull and bear cases, then, looks like this. The bear case is right about the near term. The Onchain indicators have not yet reached the conditions that historically confirm a definitive cycle bottom. Long-term holders have not yet reached 85%. The MVRV Z-score has not yet breached the zero axis. The realized price has not yet been tested. If you are trading Bitcoin on a 6 to 12-month time horizon with significant leverage, the bear case data should be taken seriously. A test of $60,000 or even $55,000 remains within the range of historical outcomes and is consistent with what the most reliable on-chain indicators are currently suggesting. But the bull case is right about the structural picture. The ownership base of Bitcoin is transforming in a way that has never occurred before. ETFs are purchasing more Bitcoin than miners produce. Sovereign reserves are accumulating. Corporate treasuries are not selling. And JP Morgan projects that 2026 will set new records for total crypto inflows. You cannot have a structural catastrophe in a market where institutional infrastructure is expanding this aggressively. The bear market may not be over today, but the era of 80% plus corrections driven by retail panic and exchange collapses, that era is almost certainly over. Which brings us to the final and most important question. What do you do with this framework? The answer is not a price target. It is not a buy signal. It is a disposition, a way of holding both the near-term caution and the long-term conviction simultaneously, without being paralyzed by the uncertainty between them. Let's come back to October 6th, 2025. $126,198. The day Bitcoin reached its cycle high. If you bought on that day, you are down 46% today. If you bought in 2020, you're up approximately 700%. If you bought in 2017, you're up approximately 1,200%. If you bought in 2013, the number is obscene. The only variable that separates those outcomes is not skill. It is not insider knowledge. It is not superior technical analysis. It is time horizon and conviction. Specifically, the conviction to hold through the bear markets that separate every cycle high from the next cycle high. Here's the one thing that every bear market analysis misses. Every previous Bitcoin bear market was eventually followed by a new all-time high. Every single one. 2015, 2018, 2022. The people who sold at the bottom, convinced the bear market was permanent, bought back in later, if at all, at higher prices. The people who understood the structural thesis and held through the pain came out the other side at multiples that made the bear market irrelevant. The question is not whether the bear market is over today. It might not be. The on-chain data suggests it might not be. CryptoQuant is calling for $55,000 to $60,000 by December 2026, and that is a serious projection from serious analysts. The question is what you believe about the structural thesis, about whether Bitcoin's transformation from a retail-driven speculative asset into a sovereign reserve asset, held by governments, ETFs, corporate treasuries, and the largest asset managers in the world, changes the terminal value of this asset. If you believe the structural thesis, if you see the institutional accumulation data, the supply-demand arithmetic, the sovereign adoption curve, and you conclude that what you are watching is a maturing asset in a bear market rather than a dying asset in its final collapse, then the bear market is not your enemy. It is your last clean entry window before the 2028 halving resets the supply dynamics again. If you are uncertain, if the on-chain data and the CryptoQuant projections give you serious pause, then the honest move is not to act on conviction you do not have. Patience is a position. Cash is a position. Waiting for the MVRV Z-score to breach the green zone before increasing exposure is not weakness. It is discipline. And discipline, not price prediction, is what separates the people who compound across cycles from the people who get destroyed by them. Professor Zhang would say this: the market does not care about your time horizon. It operates on its own. Your job is to understand the phase you're in, hold the correct conviction about the structural direction, and not confuse short-term price pain with long-term asset failure. The bear market of 2026, if it follows the historical pattern and reaches $55,000 to $60,000, will feel like the end. It will feel exactly the way 29,000 felt in 2022. And the people who sold at 29,000 are the people who are watching this video wondering how they missed the recovery to 126,000. So here's your framework. 2 questions. Question 1. Do you believe the structural thesis? Do you believe that sovereign reserves, institutional ETFs, and the fixed supply of 21 million Bitcoin create a long-term value floor that rises with each cycle, regardless of how painful the near-term correction gets? Question 2, what is your time horizon? 6 months, 2 years, 10 years? Because the answer to question 2 determines whether the crypto quant iron bottom projection is a risk to avoid, a price level to wait for, or simply noise in the context of a multi-year accumulation strategy. If you have sat with this video all the way to this point, if you have stayed through the on-chain analysis, through the halving cycle debate, through the bear case, through the reconciliation framework, then you are the kind of person who does not need someone to tell you what to buy or sell. You need a framework, and you have one now. The bear market may not be over. The data says it might not be. But the era in which a Bitcoin bear market means 80% crashes, exchange collapses, and the extinction of institutional interest, that era is over. What you're watching is the most heavily institutionalized bear market in Bitcoin's history. And institutionalized bear markets do not end in oblivion. They end in accumulation, and they precede the largest structural repricing events the asset has ever seen. If you stayed to the end of this video, if you sat through every indicator, every chart, every bear case argument, every reconciliation, then you're exactly who this channel was built for. You did not come here for a price prediction. You came here for clarity, and I hope that is what we delivered. Now, I need to know something from you. Drop one of 2 codes in the comments right now. If you watch this video and you believe the structural thesis, if you believe the institutional accumulation, the ETF supply dynamics, and the 2028 halving create the conditions for Bitcoin to recover and make new highs, drop I see the bulls. If you watch this video and the on-chain data landed harder, if the MVRV score, the realized price gap, the crypto quant iron bottom projection at $55,000 to $60,000 makes you think the real bottom has not printed yet, drop I see the bears. No wrong answers, no judgment. Both positions have serious data behind them, and I want to see where this community stands. Your comment tells me what to build next. Hit subscribe, hit the bell, because what comes next in this channel is the geopolitical layer of this market, the part that connects the bear market bottom to the sovereign accumulation race that no mainstream outlet is covering honestly. You are not going to want to miss it. This is Engineered Markets. We will see you in the next one.